What I find interesting about India is that India has far more tailwinds than the S&P has or the US has. Growing population, emerging and, massive amount of per capita and GDP growth. I mean, you can just see it everywhere. There's a big difference between investing in a great business and making a great investment. So we know, for example, that Hindustan Unilever is a great business. If I were to ask us to make a list of the truly exceptional businesses in India, most of us would not have difficulty coming up with such a list. Varun Beverages is an exceptional business. Is he a YPO?
No, I don't think so.
Okay. I don't want to offend people, Pardon? Okay. But exceptional business, terrific promoter, great management. I gave a talk last December at Flame University where I compared Varun Beverages to a Coke bottler based in Istanbul. And the Coke bottler based in Istanbul has roughly about 2 times the volume that Varun does. They bottle in about 14 countries. Coke just gave them half of Bangladesh. They do all of Pakistan. And they do all of Turkey and a bunch of other countries. And we can compare Coke and Pepsi bottlers around the world. The Coke and Pepsi bottling business around the world is very similar. The economics are very similar. And you can make some adjustments for growth rates and such. The Turkey business trades at about close to 1/8 or 1/10 of the effective valuation of Varun. And Varun trades at something like 5 times the effective valuation of all other Coke and Pepsi bottlers around the world. So if I look at Coca-Cola FEMSA in Mexico, phenomenal business. 1/5 the multiple or less than 1/5 the multiple of Varun. And I see that play out in a number of different businesses in India where the businesses are exceptional. There's a huge amount of growth ahead, truly exceptional promoters and management, but you're paying a lot to have a seat at the table. In the end, the stock market, like Buffett says, is a voting machine in the short term. It's a weighing machine in the long term. So in the end, everything gets weighed appropriately. And so I had just suggested that if we were to go 5, 10, 15 years in the future, and we looked at these 2 businesses, Coca-Cola ISEC in Turkey and Varun Beverages in India, and we just looked at kind of where they end up 15 years from now in terms of investor returns. Varun's trailing PE is more than 100 in terms of current PE. And so I think that's the difficulty I think that India has, is that there are tremendous tailwinds, but it's also a place where there are lots of great investors and not that many businesses with exceptional corporate governance. So if you take the entire listed space and let's get to the ones that have great governance and great moats, you might end up with 100 businesses. And all the money goes into those 100 businesses, the SIPs every month. So the result is predictable. And one of the things about investors is that investors love to have lemming behavior. So they believe that whatever has gone up recently will keep going up. And so it just kind of perpetuates, But eventually things do get to a head and then a new cycle begins. So that's how I look at it. I think that the S&P, what I would do if I were in the US, if I was forced to be an index investor, I would take the equal weighted S&P rather than the normal S&P, where each business in the S&P has a 0.2% weight. It's equal weighted. That way you get rid of all the tech euphoria. And the Nifty in India, I mean, I think it's been a great place to be, but I don't know whether I could be very bullish about where it is 10 years from now.
So let me ask you a businessman's dilemma that we debate in our office all the time. So let's say I have 2 options in any business. One is I can do lower ROCE business, which is high growth in my industry. I can veer towards that. Or on the other hand, I can veer towards a higher ROCE business, which is more niche and therefore has lower growth. as a businessman, my tendency would be, let's go with the high ROCE. Growth matters less. But the markets reward exactly the opposite. They won't care whether I'm in the low ROCE business or not, but they'll reward growth. How do you balance this? It's not either or. How do you balance this ROCE versus growth?
Yeah, so I think that this is actually the dilemma Berkshire Hathaway faces. So if you look at something like Berkshire Hathaway today, it's 800 billion market value. They have to put 50, 60 billion out at a time to move the needle. And there are very few places that you can put 50, 60 billion one shot. How many businesses in India have a market value more than that? So the conclusion Buffett and Munger came to was that we have to keep running the runway at a lower rate. And so I would say between the two, it's important to keep compounding, and it's important not to be the flash in the pan, if you will. So if you've got some consistent growth, but it's low ROE, and at the end of the day, it boils down to opportunity cost. So you have limited dollars to invest. If in the near term one is giving you a high ROE, you can put money there, but you may not be able to put much money there. The other one may be able to absorb the rest. And that's how we do it. So everything boils down to opportunity cost.